In today's video, we will tell you all about the S&P 500, what its components are, how exactly it works, and finally, how you can use it to make money. The stock market brings several technicalities with it. Unfortunately, many people fail to comprehend the idea of the stock market, which makes them poor investors. While people who want to know how to make a good investment don't know where to start. They're confused about how to invest in the stock market. So how are they supposed to enter the stock market, and what exactly is the stock market we're talking about here? It is the S&P 500 stock market index, of course. Before we begin, don't forget to like this video, and be sure to subscribe and turn notifications on to be notified when a new video comes out so you can receive all the latest financial tips. And if you know someone who would benefit from this video, please share it with them as the awesome person you are. Without further delays, let us dive right in. Number 1. What is the S&P 500? Interestingly, the S&P 500 index didn't start with that name. It was initially called the Composite Index. It started all the way back in 1926, trading 90 stocks, and by 1957 it grew to 500 stocks. When it grew to 500 stocks, the Composite Index sponsor, the Standard & Poor's Corporation, declared the index after its name. And because it has 500 companies listed within its index, that's why it's called the Standard & Poor 500 Index, or in short, the S&P 500. The S&P 500 is a market capitalization weighted index of the 500 largest companies in the United States. It is not exactly a complete list of the top 500 U.S. companies by market capitalization because there are other demands in the criteria considered to be included in the index. Nonetheless, this index is regarded as the best gauge of large-cap U.S. equities. Different common U.S. market standards include Dow Jones Industrial Average or Dow 30 and the Russell 2000 Index, representing the small-cap index. The S&P 500 is divided into 11 sectors which have different percentage splits that make up the overall index. 22.6% of the stock in S&P are tech stocks. Healthcare contributes to 13.44% of the total stocks. Consumer discretionary makes up 12.7%. Communication services is 10.79%. Industrials is 8.47%. Consumer staples is 6.55%. Utilities is 2.73%. Materials is 2.64%. Real estate is 2.41%. And finally, energy is 2.33%. If we drill down even further on those 11 sectors, they are 144 industry groups. Number 2. How the S&P 500 works. The S&P 500 tracks the overall market capitalization of companies listed in its index. The market cap is the total value of all shares of stock that a company has issued. The market cap is calculated by multiplying the number of shares issued by the stock price. A company having a market cap of $100 billion receives 10 times the representation as a company whose market cap is $10 billion. In July of last year, the entire market cap of the S&P 500 was standing at a mammoth $27 trillion. An important thing to note about this index is that it does not count the shares held by companies, government agencies, or control groups. It only measures shares available to the public. How is it decided which companies are listed? A committee selects each of the 500 corporations listed on the index based on their liquidity, size, and industry. It's also important to note the industry rebalances the index quarterly in March, June, September, and December. The S&P 500 focuses on the U.S. market's large-cap sector. It is also a float-weighted index, meaning company market capitalizations are adjusted by the number of shares available for public trading. And finally, the S&P 500 is one of the most widely quoted American indexes. This is because it represents the largest publicly traded corporations in the U.S. and is a general indicator of how well the company is doing. Now, there are some criteria required for companies to qualify for the index. Firstly, the company must be based in the United States. Secondly, it should have an unadjusted market cap of at least $8 billion. Third, at least 50% of the corporation's stock must be available to the general public. Fourth, the lowest value of the stock price must be $1, and it cannot go lower than $1. Otherwise, it will be removed from the index. And finally, the stock must be listed on the NYSE, Investors Exchange, NASDAQ, or BATS Global Markets to be placed on the S&P 500. As of August 31, 2020, the 10 largest companies in the S&P 500 were Apple, Microsoft, Amazon, Facebook, Alphabet A and Alphabet C, both are also known as Google, Johnson & Johnson, Berkshire Hathaway, Procter & Gamble, and Visa. Number 3. How to make money using the S&P 500. Even though you cannot invest in the S&P itself like an individual stock, you can mimic its performance using an ETF called the SPY. The SPY ETF is the main index fund many people talk about when they say to invest in the S&P index. ETF stands for Exchange Traded Fund and is a collection of stocks that are picked to represent a specific investment. Another option is buying shares of stocks that are listed on the S&P 500. Investing in the S&P 500 is a way to gain broader exposure to large US-listed shares. You can use the S&P 500 as a leading economic indicator of how well the United States economy is doing and the right environment to invest in, also known as a bull run. Comparing its performance in the last 10 years, the S&P has done slightly better than previous decades with a 13.6% annual average return. With a growth rate of 13.6% on an annual basis, if you invest $100, after 10 years it would be $358, a profit of $250 or 2.5 times your initial investment of $100. If investors are confident in the economy, they will buy stocks, thus increasing the price due to supply and demand. The S&P 500 is extremely important for mutual fund managers as their performance is compared to the S&P 500, meaning if a mutual fund manager gains 15% for your money, you would consider a 15% increase in your money a good investment. However, if the S&P 500 goes up by 20% during that same time, compared to the S&P 500, the mutual fund manager underperformed, meaning you would have been better off investing in the S&P index itself to grow your investment than with the mutual fund manager. Thus, it's best practice to always compare the performance of investors to the S&P 500. If you're interested in investing in the S&P 500, you will need to get yourself a brokerage account to buy and sell shares. After that, choose between individual stocks and/or ETFs you would like to invest in. ETFs such as the SPY or Vanguard 500 is the best starting place to start making money using the S&P 500. The Vanguard 500 index fund seeks to track the price and increase the efficiency of the performance of the S&P 500. It does this by holding stocks across several sectors with approximately the same weight as the S&P index outlined early in this video. This way, the fund barely deviates from the S&P in performance, which it is designed to mimic. Another key in making money using the S&P 500 is to keep an eye on the fees before you begin, as these can eat into your annual returns. Finally, you will be entering the trade using your brokerage account and voila! You're a stock or index fund owner. Yes, it really is that simple to make money using the S&P 500. Of course, this isn't financial advice by any means, but financial education for you to learn from, and please invest at your own risk. However, the risk is always worth it. If you enjoyed this video, give it a like. Be sure to subscribe and turn notifications on to be notified when a new video comes out so you can receive all the latest financial tips. And if you know someone who would benefit from this video, please share it with them as the awesome person you are. Summarizing what we learned in this video, the S&P 500 is used by investors to assess how the overall stock market and the economy is performing. In addition, the index tracks the 500 publicly traded companies with high valuations and stock prices over $1. Finally, you can make money by purchasing stocks listed on the S&P 500 or invest in index funds that track the S&P 500, such as the SPY ETF or Vanguard 500. That's it for today's video. I hope this video has brought you value, and if it has, make sure to comment below on what you learned or your biggest aha moment. And I will see you in the next video.